All right. Sorry about this. Let's go through. We're right now on our second objective. So we talked about two approaches, and we've done a lot of the contribution margin approach, right? And I believe we stopped right here, right? No, we didn't. Right here. Okay. So let me to make a connection. Let me go back a slide and go over this with you. Okay, so our very last part was on the shortcut method. And we said that the reason why it's called shortcut is because you have to do so much less, right? All your calculations are ended with what? With your sales revenue minus variable costs. And we found contribution margin, and then we subtracted fixed cost, and we got operating income. Okay? So let's go next. Okay, so what are we going to do right now? We'll rearrange our income statement, and we'll use our contribution margin so that we develop a shortcut method. So let's look at these formulas. What do we have here? We're going to find here some numbers of products or services, right, that we need to provide to break even. So what does it mean here? Some of it we've discussed as well. So let's look. We have our sales revenue minus variable cost minus fixed cost, and that's how we find our operating income. Right? I'm going fast because we've discussed all of it. So sales revenue, we said, is the sales price per unit multiplied by units sold. And variable costs are your variable cost per unit multiplied by units sold. Right? So we are kind of dissecting our formula in smaller components. Then again, we're subtracting our fixed cost, and we get operating income. Okay? So now what we're going to do, we'll take unit cost out of brackets, and what are we going to get? Sales price per unit minus variable cost per unit. Brackets closed. We multiply by unit cost. And we also move your fixed cost to the right. So your fixed cost per operating plus operating income. Right? So now we know that the contribution margin per unit is the difference between sales price per unit and variable cost per unit. So here you go. We have contribution margin per unit multiplied by units sold, and that's equal to fixed cost plus operating income. So now let's derive this shortcut equation. If we divide both sides by units sold, we're going to get contribution margin per unit, right? So let's look at this. The other way around as well. So if I need to know how many units I need to produce to break even or find contribution margin approach, we're going to use this formula, okay, right here. And that's your shortcut. So my units sold to break even is fixed cost plus operating income divided by contribution margin per unit. Right? Okay. So we know that, do you remember that example with events that we're scheduling? So our fixed cost we knew was $12,000. The same example, we're still working on it. Okay, so what do I have here? My fixed cost is $12,000. My contribution per event is $120. So what is $120? Just to remind you, we said that the sale price is $200 and our variable cost is $80. So we subtract those two and we get the contribution margin per event. Okay, so how do we calculate the break-even sales units? 12,000 we divide by 120, and here we find that to break even we need to book at least 100 events. And then we also checked our answers, right? So we found operating income at the end is 0, and that's exactly what we need when we break even. Our operating income is always 0 when we're dealing with breaking even. Okay, so getting right at the new material, just a little more. So what is the contribution margin ratio? We said that companies can use this contribution margin ratio to compute the break-even point, right? Okay. What I want you to understand is that the contribution margin ratio is the ratio of contribution margin to sales revenue, right? So let's look. Contribution margin ratio is my contribution margin divided by sales revenue. This is an important formula to understand. So if I need to calculate anything in sales dollars, right, my break-even point in sales dollars, that's the formula I'm going to be using. I'm going to take my contribution margin and I'll divide it by sales revenue. So my contribution margin ratio also is very different. This approach is very different from the shortcut. Okay, so let's look. My contribution margin is sales price minus variable cost, right? We just looked at that as well in the formula. And then sometimes we need to find a percentage. So my contribution margin is going to be divided by sales revenue, and that would yield the percentage. And that's going to be what percent of each dollar of sales revenue contributes toward the fixed cost and profit.
Does it have to be contribution margin over sales? Maybe sales over contribution.
Well, I'm looking for contribution margin ratio, right? So it's contribution margin to sales, right? That's just from the name of contribution margin ratio. So your first is going to be contribution margin divided by, right? Okay. So next, let's look really quick. What do we have here? Why do we need this contribution margin ratio formula, and how does it work? So the formula, as we discussed, is break-even sales in dollars. That's equal to fixed costs divided by contribution margin ratio. So let's look. What does it mean? We have this example, right? We're at $12,000. Do you remember it was just right here? So my fixed cost is $12,000. Still same thing. So what is it saying? My contribution margin ratio is 60 cents. What do you think does it mean? Just as we said, it means that 60 cents for each dollar that Greg's sales contribute 60 cents to fixed costs and profits, right? Percentage of each dollar of sales revenue that contributes toward fixed costs and profits. So here's an example to you. That's what it means. Each dollar of Greg's sales contributes 60 cents to his fixed costs and profits. So what does he need to do to break even? What Greg needs to do to break even, he needs to generate enough contribution margin at rate 60%, in other words, right, of sales, so that he covers that cost. Okay, so my contribution margin ratio yields the same break even as the contribution margin approacher that we just discussed. Okay, so my sales per unit was what, $200, and my contribution margin per unit is 120, in other words. So let's try an example really quick. Did I just give it? Yeah, I did. Well, you didn't see that. Okay, so Story Park competes with Splash World by providing a variety of rides. Story sells tickets at $50 per person as a one-day entrance fee. Variable cost at $10 per person and fixed at $240,000 per month. So let's see how many tickets Story must sell to break even. Just take 2 minutes. It's easy calculation. You're going to use the formula for units sold, right? Just like we saw a second ago. This one. So what am I going to do? I'm going to sum my fixed cost and operating income, and I'll divide it by contribution margin per unit. And this is how I have my units sold. Do I have anything about my operating income here? That means it's a 0, all right? And how I'm going to calculate my contribution margin per unit? I'm going to take my variable cost and fixed cost, do some calculations with them, and that's my contribution margin per unit. Note that this is per person, right? Sales tickets 50 per person, and variable costs are 10 per person. So it's already per unit. So let's look. Anyone wants to say what number it is? What is the unit sold? Yeah? That's correct. All right, so units sold is 240,000 plus 0, yeah? And we divide it by 50 minus 10. So we have units sold equal to 240,000 divided by $40, and that's my 6,000 units to break even. Okay? All right. But that's not the end. So let's do the second part. Perform a numerical proof to show that your answer is correct. So to do that proof, do you remember I started with this? We had a table. Well, we had the total sales revenue minus variable costs is your contribution margin, and then you also subtract your fixed cost, and that's how you get your operating income. So at the end, you should get a 0, and that's how you do this verification. So try really quick to verify if your answer is correct. If we got this number 60,000 correct. 6,000. So I'm going to take my variable cost is going to be what? 6,000 multiplied by, what's my variable cost? By 10, right? And then I'm going to take also 6,000 and multiply by sales, right? And that's going to be 300,000. So let me give you a minute to try it on your own first. Okay, so your total sales revenue is 300,000, variable cost is 60,000. We subtract 2, one from another, and then contribution margin is 240,000. And then I also subtract my fixed cost, and my operating income is 0. That means the number that I got is, in fact, break even. Okay? So here I also wanted to remind you that your operating income is contribution margin minus fixed cost, right? So always keep this formula in mind. You'll see that. Okay. Continuation of the story about the story park. So let's compute story park's contribution margin ratio. Okay? Our ratio is the percentage, in other words. So how do we compute the ratio? We just talked that there is a formula, right? Yeah. Okay, so what am I going to do first? I'm going to take $50 and I'll subtract 10. Why would I do that? That's right. That's right. So that's going to be my $40. And then I'll take that $40 and divide by 50, right? So that's it. Pretty easy, right?
Why did you divide that by 50?
Because that's my sales price, right?
So, I thought your sales revenue was you're dividing by.
Huh?
So if you divide your contribution margin divided by your sales revenue? So your contribution margin is your 15 minus 10?
Yes. Right? My sales price, and I subtract my variable cost. You want to go back to this slide right here, what we're doing here. Contribution margin is equal to sales price minus variable cost. So the same is true for each unit, right? Okay, so let's do another. Have we done this? No. So use the contribution margin ratio that we just went over again, CVP formula, to determine the sales revenue. So we're going to look for sales revenue that we need to break even. So we're going to take that margin that we just found, right, the ratio, and we'll use also fixed costs. Okay? So once you get the number, let me know what it is. 300,000, that's right. So you took 240,000 and divided it by 0.8. All right? Okay. So we have a lot of material in this chapter, so let's move on. Next, what we're going to do, we'll talk about how do we use CVP analysis for profit planning. And we'll try to graph it. So on the exam, I'm not going to ask you graphing it, really. But we want to understand and we want to see how does it look like so that it's a better picture to us. Okay. So using CVP, we're going to talk about how we use CVP to plan profits. Obviously, this is something that is a very useful tool for managers. So managers, to establish some products and services, managers are more interested in sales level that we need to achieve a break-even point rather than break-even point itself. Okay. So what is the sales level? What the sales level should be to achieve a target profit and surpass the break-even point. All right, so let's look at this. So like we said, our managers are most interested in sales level. Our profits are extremely important to us. And how many products or service events must be sold to be at that level of profit. So we're going to use either profit. We have here two formulas. So what are those two methods? Do you remember? Contribution margin approach. And what? Anyone? Huh? Huh? Income statement. Right? You were close. Okay, so what are we going to do here? We'll set our operating profit equal to desired profit. Makes sense, right? Our operating income, we'll set it as our desired profit. And that's how we're going to deal with the same formulas right now. So not much is changing. Okay, so we have sales revenue. Our total cost, variable cost minus fixed cost, same story, is our operating income. You know this formula. So here's what we want to understand right now. Sales in dollars, target sales in dollars, is our fixed cost plus operating income divided by contribution margin ratio. That's something quite new, but maybe not. We've seen that, right? Okay, so here's how do we plot all of this. We need a plot so that we can see all the changes and variations in numbers. And there are 4 steps. First, we're going to choose a sales volume and plot the point for total sales revenue at that particular volume that we are looking for. So for example, if I'm looking at 200 events right here, and there are 200 per event, right? Then my sales is what? 40,000. So I'm making first a little table before I plot, right? So my sales revenue from the origin 0, right? My origin, through the 40,000 plot. So we'll start at that for right now. Just keep that in mind. So why do we start at the origin? Why do you think we need this origin? What for? Because if we do not have any events, right? If events are zero, our revenue is again 0, correct? So we'll start at the origin 0. Do you remember how we had fixed and variable cost last class and we didn't really start at 0? So I want you to pay attention to this. Right here, your events and your sales revenue are both 0. Okay, let's look at step 2. We'll draw the fixed cost line. We'll use those 2 points and we'll draw it. Okay? Let me show you right here. What am I talking about? So here's my fixed cost, right? That's my origin. That's the line at 40,000. But here is the 12,000. I'm going to draw this fixed cost line. So I'm going to use this 12,000, and it's going to be a line parallel to axis of events. So let's look at 3. I'll go over the chart again, but let's look at this in just step by step. Now we're going to do we'll draw the total cost line. That's a sum of variable costs and fixed costs. So what am I going to do here? I'm going to first look what are my variable costs and what are my fixed costs and figure out where is it going to start. That's going back to last time class. Okay? Okay. So we said that at 200 events and $80 per event, we have variable cost of 16,000. Right? Show you. So let's look first here before we go back. So my 16,000 plus 12,000 is 28. So let's go back to 28. Somewhere here, right? So what are we going to do next? We're going to do 200, right? It's 200, that's a break even. 228. Here's my point. Okay? That's how we're going to find our variable, total cost, sorry. That's a part of variable, and this is a part of fixed cost. So let's go back. Total cost line, right? It's a variable cost plus fixed cost. We figured our variable as a summation, total cost as a summation of variable and fixed. Here is a 28 at 200. Okay, I'll explain to you once again if you didn't catch that. And that's my 12,000 that we just put on the graph that was fixed cost. So I used 1 point here, and I used 1 point at the fixed cost, and that's my blue line as a total cost. Okay? The last one will identify the break-even point and the areas of operating income and loss. All right. So why, if we can calculate all of it, why do we need this graph? Not really clear, right? Sometimes using either one of the approaches is not sufficient. We really need to have a visual representation. So here is the break-even point. We've had that also calculated, right? Here's the break-even point. At $20,000, I have 100 events, right? All the numbers seem to be correct. So my operating income is to the right of my break-even point. My operating loss is to the left. Okay? So operating income is over your sales revenue but under your total costs. Just think about this. So if my total costs at 50 events is greater than my sales revenue at the same number of events, I'm at a loss. Does it make sense? If you forget how this looks, just picture and just make an example. At 50 events, my operating loss is my sales revenue is just over 8,000, but my total costs are at 16,000, right? So it's operating loss. And let's look here. My operating income is between two lines, total cost and sales revenue. So my sales revenue at every point is greater than total cost. That means it's an operating income, right? So here's what I'm going to do. I'm going to take it, if I have 150 events this period, I have about 24,000 in costs, and I have somewhere under 32,000 in sales revenue. Well, that sounds good, right? So it's an operating income. All right? And my total cost, just to go over this again with you. My total cost, how am I going to find this? I'm going to add my variable cost, right? Here's my variable cost of how much? Of 16,000, right? This is equal to 16,000. And then that's my fixed cost of 12,000. So I'm going to plot this point here, and I'll also take one that's fixed cost and at 0 events, and that's going to be my second point. And then I'll draw a line through. Okay? When I'm putting on sales revenue on the graph, what do I have? I have 0, 0, right at the origin, because at 0 events I have 0 revenue, right? And then I'll also put the one right here. At 40,000 I have 200 events. And how did we find 40,000 at 200 events? We said that we want 200 events at 200 per event, and so forth. Therefore, our sales are 40,000, right? We calculated all of this. This is only a representation for you of what we've been calculating for the second class. All right, so I hope this was clear. Let's try and do an exercise here. So we'll be computing contribution margin, break-even point, and units to achieve operating income here. So let's look at this. We have number of units, sales price per unit, variable cost per unit, and total fixed cost, as well as target operating income. So we have some of this operating income right here for A, B, and C, right? Does not matter what A, B, and C stands for. We know that as for A, we're producing 1,300 units, and we sell it at $100 per unit. Our variable cost is 40, and our fixed cost is 72,000. Okay, so what are we going to calculate here? Let's try to calculate contribution margin per unit, contribution margin ratio, break-even point in units, and so on and so forth. So this is quite an exercise. I'm going to give you about no more than 10 minutes, and I'll go walk around and see how you're doing. And I'll be helping you also here on the board. So peek, okay? If you are stuck, just look here and there. So first, I'll be talking, but you do also on your own. Try, all right? So first, what can I do? Margin per unit. I'm going to use this $100, subtract 60. Oh, sorry. It's a 40. And I'll get a 60, right? You're responsible for the rest of them. I'll just help you with one of them. Now here my total target operating income is 180,000, but that's not what I'm going to be using for break-even points, right? Pay attention that it's in units, right? We have in sales dollars and then we have in units. If you saw this is hilarious. It's sales, right? So this is similar. Get this done.
Where did that come from?
Huh? That's your break-even sales in units, right? What are you asking? The last one we just discussed, so try that on your own. The last one. What is the last one? How did you get the last one? First, is this clear? Take it as a yes. What is the number here?
You add the total cost and the target operating income, and then divide that by the contribution margin.
Okay, and how much did you get?
For A, I got 4,200.
That's right. It is 4,200. Sorry.
What was the calculation for that?
So you took your operating income, you added your total fixed cost, and all of that you divided by contribution margin. Right? Okay, the same goes for B and C. Let me show you what it is. There are no calculations, but it makes sense. So check really quick and let's move on to the next exercise. Units to achieve target operating income, you're going to take your target operating 180 plus 72 plus your total fixed cost, right? And then you'll divide by 60 by your contribution margin. Okay? All right. So the next one, that's the last thing that we're going to do today, and then we'll talk about the exam. Okay? Exam and the quiz. So let's do this quite quick. I'll actually help you with this. So John Kyler is considering starting a web-based education business, ePrep MBA. He plans to offer a short course review of accounting for students entering MBA programs. The materials would be available on a password-protected website. Students would complete the course through self-study. Kyler would have to grade the course assignments, but most of the work is in developing the course materials, setting up the website, marketing. Unfortunately, Kyler's hard drive crashed right before he finished his financial analysis grade. However, he did recover the following partial CVP chart. Okay, so we have this. What we need to do, we need to label each axis: sales revenue line, total cost line, fixed cost, operating income area, and the break-even point. So let's start. What axis is which one? What is this axis? The X1. Units or total sales? Okay. What is this one? Okay. Now, what is this? The red one. Sales what? Sales revenue, right? What is this one? Am I showing on the blue? Yes, the blue one. Okay, what is this? What is that? And what is this? Cool. Okay. So if, I could have done this. Oh, we missed the fixed cost. Where is the fixed cost? We don't know that yet? Right? Really? How do we know the fixed cost? That's right, it's this point, right? And then we're just going to move it, draw it all the way to the right, and it's going to be parallel to the x-axis. Right? Just like that. Okay, we've done that. Good job. Oops. Okay, so if Kyler attracts 300 students to take the course, is it going to be profitable? 300 students. It's going to go up. Uh-oh. All right. Okay, and it's even a possible loss. What are the break-even sales in students and dollars? How do you know that it's 400? You go all the way down, right? Here it's 400, and then we go all the way to cost. Okay, to dollars, right? Axis. Okay, 40,000 in sales and 400 students. Good job.